Hey, you ready to go? Let me move all my windows around. Yeah. Yeah, I have like 10,000 windows open. Hang on. All right, let's turn the music down. Good morning. How are you? How are you? Welcome to Forex.Today, the wonderful happy place you go to at least once a day. Today, we are going to do technical and fundamental analysis. Why? To try to reduce our risk and improve our consistency through planning our trades in advance. We will use technical and fundamental analysis, the overriding goal of, like I said, reducing risk. Oh, not just to make money, sure, but really it's to reduce our risk and improve our consistency. And as I said in my book 12 years ago or 15 years ago or whenever it was, 2008, it actually, if you want to talk about the trader psychology part, because you spent so much time planning and researching and preparing, it reduces stress. It's a trader psychology thing. Yeah, it actually reduces stress. So anyways, I'm here to make your life wonderful and easy if possible. So let's get on with it. Let me remind you that trading is risky. It's not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. My name is Wayne. Been trading currencies for almost exactly 20 years now, about 18 or 19 years in front of other people. Before that, I was a venture capitalist, and I was forced to decide, do I keep my dream job? After being promoted vice president of the firm, we had about 300 employees. That's a pretty big firm. They just made me VP, and I said, damn it. Why did I say damn it? That's a good job. I like what I do. But I'm also doing Forex on the side. That's a problem. So I was forced to make a choice, and I chose Forex. So anyway, it was a big deal for me to become a Forex trader. I gave up my previous life as a high-tech entrepreneur and later as an investor. So in my profile, it shows that I was in Canadian newspapers, Japanese high-tech startup magazines. I was in Inc. magazine's hot startup issue, Tech Week, all these, right? Spoke at conferences around the world, was hired by the South Korean government to consult with their startups. And I threw all that away. It sounds like I was on a path, doesn't it? You're like, oh, dude, that's pretty good. That's a good start to life. Yeah, it was a pretty good start to life. Threw it all away to become a Forex trader. So here we are. Isn't that interesting? So I learned a lot of things after making that decision. A lot of things. Made a lot of mistakes. But I got better. So I can share from that journey is all I'm saying. I can share from that journey. I also went on to get a degree in macroeconomics. So I know a few things about that. My master's degree is a mix of finance and management. So I know a few things about that too. Cool. So all I'm saying is you can download it from here, I guess. I guess not download it. You're streaming this as well as the experience that this took me through. So cool. So let me know how it can help. In the description below today's video, there's a link to my book. That might be helpful. There's a link to fxbootcamp.com. It says 65 hours of training videos in the description below the video, but I've been told it's more like 88. So for $1 an hour, you can learn Forex. You can also join some of my live groups. Cool. That's in the description below. Hey, you want a broker with a fast execution speed? One that doesn't trade against you? Sounds good? An ECN? Yeah? Straight through processing? ECN? Boom, boom, boom. Yeah. ECN, SDP? I recommend tradersway.com. That's what you need. There it is, son. There it is. All right. So I got a lot going on here, and I need to organize. So anyways, maybe we'll just go through window after window. I need to read through this. This is the PPI, just came out not long ago, about half an hour ago. Okay, so I need to go through this with a fine-tooth comb and pick through it before I make any judgments on was it good, was it bad. Okay. So anyways, right? So that's all I'm saying. So I'll link you to the PPI. You can go through it with a fine-tooth comb as well. Now, was it yesterday or the day before? I guess, was it Tuesday today? I guess it's Tuesday today, so it must have been yesterday. Did I cover the aspect of a slowing economy, changing consumer behavior, and moving from steak to chicken, from chicken to tuna, or from Target to Walmart? Did I do that here, or was that in the day trading group? Oh, thank you, Denise. Appreciate that. I really do. Denise left a review of my book on Amazon.com. Yeah, there was a glitch yesterday, so yeah. I was going to do part of it, yeah. But, yeah, it was here yesterday, and I talked about if the economy is slowing down, consumer behavior will shift, right? And change in in specific ways. One of them, I highlighted consumers moving away from Target and spending more money at Walmart, right? Walmart is up 8% today. Thank you. Yes. Target to Walmart to Dollar Tree. There you go. I'm not the only one staring at the sun. I'm not just deaf and dumb, staring at the sun. Yeah. So anyway, cool, right? Yeah, I did actually. You know, I'm a funny dude. I do stuff like that. I did go to dollar stores. I don't know if it was a dollar store or Dollar Tree. I don't know. They're all dollar stores to me. Whatever it is, I don't know if it's the other ones. But I go in and I look around. And I look at things. So I looked at soup. Did you know the cans are like 1 ounce smaller? Did you know the ingredients are different? Did you know the calories are different? I mean, that's the detail I'm looking. Is the dollar store simply a place to get cheap stuff? No. They manufacture things to sell at the dollar store. I find that just crazy interesting. It's sort of like people going to the Polo outlet store to buy some Ralph Lauren stuff, and they're like, look, it's only $90. It's usually $700. That's what the sticker says, but it's not the $700 item. It's not. It's not even made out of the, it's not made in the same factory. It's not made in with the same material. It's not made with the same care. It's amazing. Now, right? It's amazing. I haven't been to an outlet mall in a while, but the last time I went, and it was pre-COVID, so I don't know how many years ago it was, but I was shocked. But it shows you how dumb I am. I'm like, everybody here is poor. I'm like, oh my God, what are these guys buying $110 sweaters for their babies? I'm like, dude, don't buy $110 sweaters for your babies, even if you're rich. The baby doesn't care. Like, so anyway, so that's how dumb I am. So, but apparently rich people don't go to outlet malls, you know? So, wow. Anyways, so there is a shift in consumer behavior. We talked about it yesterday, and Walmart's booming, son, booming. And the stock is up 8%. Why? Is it a good sign? No. People feel, whether it's true or not, feel less and less rich and are currently changing their behavior. Kind of like a NASDAQ company that was untouchable, like I'm going to call it Facebook, because Meta's so stupid. Meta, Facebook's laying off, 10,000 people? Amazon's laying off 10,000 people. Uh-oh. Everybody's laying off now. Wink, wink, nudge, nudge. People are shifting. They're going to change their behavior. They're going to change where they shop. They're going to change what they buy. And that could change whether it's American products or foreign products. As if it's foreign products, it weakens the dollar. But my point here is it's happening in front of us right now. What you would call a recession is happening in plain sight if you read the economics. So even if the inflation numbers are improving or not improving, whatever subjective matter you or quantitative matter you want to review, it as an economist, I want to look at the shift in consumer behavior. So like, what if prices don't come down? What if spending stays the same? Did anything happen? Well, if you change where you spend your money and what you spend your money on, then yes, something has happened. Even if the amount of money you spend hasn't changed, if what you buy and where you buy it changes, guess what? You sell Saks Fifth Avenue and you buy Walmart and dollar stores. You follow? By the way, I recommended that as COVID was hitting. As COVID was hitting. I'm like, you need to shift your investments because people are going to spend differently. And of course, COVID, everyone spent on Amazon. Okay. And now less people need to spend at Amazon, but nonetheless. By the way, I got a tidbit from somewhere and I can't prove it, but you know the guy that one of the main guys that was featured in the Big Short, the crazy guy that plays the drums. I don't know. I can't remember the real guy's name. But anyways, the real guy apparently flipped his portfolio, dumped all the pre-COVID stuff, and he's moved over and built a new portfolio. And 38% of his new portfolio, Michael Burry, I still don't even know the name. 38% of his new portfolio is my prison stock that I bought 2 years ago at the beginning of COVID. 38% of his new portfolio is the stock that I bought at the beginning. It wasn't the beginning of COVID. I think it was the beginning of the year. Remember when I saved money and I said the stock market was going to drop 10 or 20%, and then it did, and then I bought a whole bunch of stuff? No, not the exact bottom. But I bought a bunch of dollar stores and stuff like that. One of the things I bought was a prison company. X-Trader says, grim outlook on society. Heck yeah. I got to take care of my society. Me, my family, my loved ones. So yeah, I shifted over. I invested heavily into apartments because I figured when rates go up, nobody's going to be able to afford a new mortgage. So nobody's going to sell a house, but you certainly can't buy a house. So if you don't already own a home, you're never going to buy a house. Not in the short run, right? Unless you're happy with a 9% mortgage, but even the bank won't be happy with that. So you're going to stay renting. So I did that. I invested into old folks' homes. I invested into dollar stores. I invested into prisons. I did all this 2 years ago. Like, think of the logic. It's thematic, isn't it? And so anyways, this prison company builds prisons in the United States, Canada, Australia, and South Africa. So basically, you leech on poor people. Yeah, I'm like Eminem for the finance market. Yeah. Yeah, at liquor stores. I think that's in the dollar store one. No, it's not me. I'm investing into what society wants. Think of it that way. Society wants to make a shift from buying yellow Lamborghinis and McMansions that they can't afford because money is free, down to sort of more basic, right? More basic fabric society stuff. So people don't want $500 sweaters. They want $30 sweaters. They don't want, 10,000 square foot houses. They want to rent a 2,000 square foot apartment. Grandpa's getting too old to take care of. We need to put him in a old folks home. Okay? Why buy a $3 can of soup when you can buy a $1.10 can of soup? Why spend $3 on an energy drink when you can get it for $1 at the dollar store? So that's what society wants. People don't want to shop at Saks Fifth Avenue. They want to shop. They've either dropped down to Target, or they've dropped from Target down to Walmart, or they've gone from Walmart to the Dollar Tree. That's what society wants, and I'm helping by investing into that infrastructure. So am I leeching on poor people? No, because I need rich people to buy the stock too. Right? Even if the cash flow is good and the profitability is high, doesn't mean the stock price is really going to go up. So I need rich people to buy the stock. But at least those companies stay in business, right? And have good credit and can access credit markets like banks or issue bonds to raise the money to expand the number of dollar stores. You see what I mean? But as Matrix says, so basically you leech on poor people. I mean, what you need to think of is, what kind of economy will we have in the next 3 years? Next 1,000 days? Okay? Is it going to expand and everybody has more? Or is it going to contract and everybody has less? And based on your decision there, how will consumers behave? Okay, how will consumers behave? So like what I was saying, I guess I said it here yesterday too, like what happens in 5 years if every car manufacturer in the world is making a majority of their cars as electric vehicles, and then suddenly, I mean, let's say Tesla makes 2 million cars, maybe 3 million cars, okay? Let's say 3 million cars. And then Ford makes 3 million. General Motors makes 3 million. Toyota makes 3 million. Honda makes 3 million. Volkswagen makes 3 million. Okay? Mercedes, BMW, Porsche, combined, they make 3 million. All of a sudden, There's no cobalt for batteries. None. So the first thing that's going to happen is cobalt's going to go to $1 bajillion. The cost of making an electric vehicle is going to quadruple. So now your $100,000 Porsche or $100,000 Tesla is either not going to get made or it's going to go up to $400,000. But of course, it's probably just not going to get made. So what's the consequence of this? If Tesla goes from 3 million cars a year, let's say in 5 years, not today, and then suddenly they drop to 500,000, what's going to happen to Tesla stock? Also, what about companies that actually still make gasoline engines? Suddenly there's going to be a demand for that, and everything's going to shift and move over, and money's going to flow differently. And well, that would change everything, wouldn't it? We'll still have many millions of electric cars on the roads, but there'll be suddenly a dramatic slowdown in the amount of vehicles, right? So here's the interesting thing. So I invested into cobalt. Okay. I invested into the charging stations, but not the car companies. Because I could still say, I don't know how many electric vehicles we have, but let's say we have, in 5 years, let's say we have 25 million or 10 million. It's got to be close to 10 million pretty soon, right? So let's say in 5 years, we have 10 million electric vehicles on the road. They still need to be charged, maybe. Okay. But I'll make money on that because I'll make money as long as you're installing them. I'm going to make money, right? But on the flip side, the price of cobalt's going to go up and I'm going to make money on that. Okay. By the way, I looked at it yesterday. I bought 2 companies that dig stuff out of the ground. That's the same kind of play. A slowing economy. So I buy liquor stores, right? Slowing economy, I buy dollar stores. Slowing economy, I buy apartment buildings. Okay. But I'm also moving over anti-tech. I'm moving away from a company like Facebook. I'm moving away from an Apple. I'm moving away from Amazon. And I'm buying companies that do stuff, dig stuff out of the ground. And so the 2 mining stocks that I bought are paying me 11% a year in dividends. Just in dividends. 11%. So smart, right? Well, Aaron, right? Aaron, it's about thinking 5 years ahead. That's what economics is. It's the study of scarcity. And then you try to thread, 1 or 2 or 3 different visions for the future. What we call best case, base case, worst case scenarios. So you plan out if the economy recovers very quickly, China reopens, we're making good friends, the war in the Ukraine comes to a peaceful end, everything's golden, right? We don't need to go into recession. Supply chain opens up, inflation tanks. That's best case scenario. So you write all that down. What are you going to do? What are you going to buy? Maybe it's time to get back onto Apple. Maybe, right? Then you got your base case. Let's say next year's a struggle, but it's not a collapse. I think it's Wells Fargo on Friday said their year-end target for 2023, December 2023, not December this year, December 13 months from now, they expect the S&P 500 to be at 3,900. You're like, well, it's at 3,900 now. Yeah, they expect it to be the same price. That would be base case, although they expect a drop and a rise. Okay. And then what about worst case? Okay. Maida says, what's the definition of recession? Yeah, I like to think of it like Forrest Gump. Mama, what's recession? It's when your daddy goes away and never comes back. And, Mama, what's recession? It's when you lose your job. And never, right? That's what, to me, that's a recession, right? Right? That, I know there's fancy stuff. I don't care what the definition is. I don't get caught in it. It doesn't matter. Okay? To me, a recession is not a 20% stock market decline, a 50% stock market decline. You say, well, what does that have to do with the economy? Well, it's the other way around. The economy is in recession, so the stock market dropped 50%. And of course, I could break it down. I've broken it down. You know, when I do the two valuation models? Well, let me just quickly do it. Okay? Let me just quickly do it. Okay? Here's another way of doing it. Let me answer it mathematically. Subjectively, that's what I'd say. When people are losing their jobs and the stock market is not having a correction, but a real crash, like, again, I don't think we've even had the crash. Okay? We haven't even had the crash. Stock market's down 20%. Great. Talk to me when it's down 50%. Now we're in a recession. Okay? So you're right. So she says yes. So CAPM, right? So you got the expected return of a stock, okay, is equal to, how do you put this now? I think it's a risk-free rate of return plus the beta for the market times, okay, the expected return of the market, okay, minus the risk-free rate of return. Okay. So this is what is going on now. Okay. If you're not familiar, let me very quickly explain the math. The risk-free rate of the return is the yield on the 10-year T-note. It's the opportunity cost. So what this math here says, the expected return of the market. So the expected return for the S&P 500. Okay? What do you think the S&P 500 is going to make this year? So let's say on a typical year it's 10%. You expect the S&P 500 to go up 10%. But you could also just buy the 10-year T-note and be guaranteed that. Right now it's 4. So you would say the expected return of the market minus the risk-free, you get yourself to 4%, okay? But then you got to look at, okay, now you're looking at what's the value of Dollar Tree, what's, right, the expected return for a stock. So let's say that's Dollar Tree is equal to the risk-free rate of return. Oh, by the way, that's 6%. Sorry, my bad. Okay, 6%. My bad. Okay, so you get those variables down, and that's 6%. So once again, what's your risk-free rate of return? 4%. Okay, plus the beta. How much does Dollar Tree move up and down in regards to how much the S&P 500 moves up and down? And eventually you go through all the math and you get yourself to what you expect Dollar Tree to be worth based on what you think the stock market's going to do, the market, and what you think the interest rates are. So the thing is, this is what we're pricing in now. And if you understand math, as this RF goes up, the math just pushes the value, in this case, Dollar Tree, down, just based on borrowing costs or risk-free rate of return. That's the opportunity cost, right? As this goes up, this goes down. That's it. It's just the relationship. It's just the math. And that's what we're having now. But then the next one, okay, that's the beginning of a recession, but it doesn't have to put you into recession. We're changing the value of the stock market But then if the Fed just cut interest rates, then this would go back up. But we don't think the Fed's going to cut, right? So then you go to the next one and you go to what's the present value of a company, okay, based on its future cash flow over 1 plus I to the N. N is how many years. So if you want to do 2 years, it would be, okay, let's say this would be 1 plus the next year's cash flow, future value of that cash flow, over 1 plus I to the 2. Okay, this is where the recession kicks in, Meta. If you think, because up here, the one in pink is just telling us if interest rates are going up, how does the interest rate affect a particular stock and the stock market? Well, it's not good for the stock market or for the stock because they're going to be less profitable because they have to pay more for borrowing money. And borrowing money is normal for a company to buy inventory, to buy equipment, all that kind of stuff. It's just absolutely, totally normal. Okay? But what if that risk-free rate of return gets so high, interest rates get so high that not only, right, and we reflect that in the I, okay, this part, the I, we're reflecting the same thing as we do here in the RF. I and RF are equal, okay? RF is equal to I, okay? So we're saying if this goes up, then the value of a company falls, the stock price falls. But what if then it gets so high that its future cash flows are less than before? So this future cash flow, let's say 1 year from now, is less, meaning they made less money in 2023 than they did in 2022. Why? Recession. And then they made even less in the future. In 2024, it's still a bad year. So if that is happening, remember now they have less cash flow, less sales, less profit. They're doing poorly. Why? We're in recession. Therefore, the present value of this expected future puts the stock market down. And it's the combination of these things. This top part is the beginning. And if we run into a recession, then that's when the stock market drops 50%. This, right? So this is, let's say, another 30. Let's say this is a 20% drop in the stock market because rates are going up. Doesn't mean profitability is going to collapse. What if we were just going from 0% interest rates to 2% interest rates and the Fed did not need to create a recession? Would the stock market be falling? No, we'd probably hoe and hum and bitch and complain. Oh my God, the Fed's jacking up interest rates all the way to 2%. But the stock market probably wouldn't be down 20%. We would adjust. Corporations would be slightly less profitable. We'd all cry about it, but nothing would really happen. And the stock market would just continue up. Instead of having a 10% year, maybe we only have a 5% year. But then the Fed will get to 2%, stop, and then we rally and we go back to a 10% year. Not a problem. But that's not what we have now. So there could be a case for next year, aka your worst case scenario. Things get worse and we've dropped 20 and we drop another 30 from the top, right? Getting down to a 50% decline in the stock market. That could be a scenario, and that's because companies are making less money. Plus, not only are they making less money, because of the first model I showed you, the value of the money, well, actually, it's the second one. The value of the money is less. Not only did they make less money, cash flows are down, but the money they made is worth less in the future because interest rates had gone up, pushing down the value of the money. So anyways, wow. So that would be the two formulas that I would use, Meta, to really look at, recession or not. So should we look at the second model, yes or no? Well, I see things like, Amazon's laying off. Remember, we talked about that a year ago? Remember, I was laughing when Apple came out with the new iPhone. I'm like, nobody wants another Apple iPhone. Oh, well, this one has 17 cameras on it. Well, my old iPhone with 12 cameras was good enough, right? All this kind of stuff, but people don't want to buy the new app. So Apple couldn't sell phones. Amazon is laying off workers, right? Right? Facebook laying off workers, so tech's in trouble. Advertising is down. So those companies are negatively impacted. Right? You see? And so things are shifting. Those are possible signs that we are moving toward a recessionary market in the future. I've already moved almost all of my retirement portfolio to reflect a changing economy. Okay? Right. Aaron says, yeah, FedEx is laying off a bunch of people. And, it doesn't surprise me. I get mad. Now, Smith is gone, right? So they have a new guy in charge. But here's the interesting thing. This bugs me, and it shows you how awesome Amazon was. I get this, email. Oh, there's a package on the way. Oh, good. And then I get another message a couple days later. Oh, it's going to be delivered today. Good. Where is it? When's it going to arrive? Sometime today before 8 p.m. What the hell? Where's the truck right now? I want to know where it is now. I want to know if it's going to be delivered in 20 minutes from now. FedEx, for some reason, a multi-billion-dollar company with 100,000 employees, they can't tell me where the truck is, and that pisses me off. Because Amazon has trained me. They've trained me. It's 4 stops away. It'll be there in 12 minutes. Awesome! Right? Now I'm out by the mailbox waiting for my cigars. Come on, Bubba, where's my cigars? Right? So, whoa. Okay? So anyways, interesting. This is all money, by the way. It's only money. So we'll get back to it. So one of the things you're going to want to look at in the markets, are what companies are laying off, what sectors are they in, and who's going to benefit from this. Someone, right? There's usually a winner somewhere. So you're like, all right, so people are not buying stuff on Amazon and having things shipped on FedEx. Although I think FedEx is eBay, isn't it? So anyway, so people are not buying stuff on eBay. So what do? You sell eBay, you sell FedEx, and you buy dollar stores, right? Or like the guy from The Big Short, he copies me and he invests heavily into prisons. 38% of his portfolio is in that one company. And I think it's up 20% for the year. I'm loving it. So anyways, and then you break this down. Where is the inflation? So for example, I don't know if this is a good representation. It's our representation. But for example, let's say you want to drill an oil well. The steel, the piping, the casing, the steel casing is still something like double what it normally is. Which means to frack, you might have to, your number might be like $75 a barrel, instead of $60 a barrel to break even. Okay? Okay? So anyways, so that'll be some. This is the latest COT data. You can look at it your own. If you are a subscriber to the super secret, fundamentally based alert service, everything is up and updated. I spent a lot of time reading this yesterday. If you're wondering why oil prices have fallen, I'll just give you the link. I spent, I don't know, more than an hour reading this yesterday, and it was wonderful. The news is bad, but wow, I love this report. I really do. It's so good. Look how they start. This is before the report even starts. Crude oil price movements. Then the world economy. Then world oil demand. World oil supply, product markets, refining operations, the tanker market, crude and refined products trade, commercial stock movements, balance of supply and demand. Then you read this wonderful featured article, and then you get to the report. It's so awesome. Thank you, OPEC. I mean, really. So this is what moved the oil market. I got punched in the face yesterday. I bought, I believe, twice somewhere around here. And I tried to grab it pretty low, and that's even failed. Okay? So what's the link? I just posted it. Oh, wait. Sorry. It gave my local. Hang on. It's OPEC. Just go to the OPEC website. Jesus Christ. Come on, guys. Seriously? You're like, I don't know where to get it. Go to the OPEC website. Jesus, Murphy. Hang on. I mean, dude, right? So it was great reading. Like I said, I might have spent 90 minutes yesterday just reading through it and having fun, enjoying it. It's beautiful. Okay? But if you're wondering what the hell happened yesterday, there's your answer. Okay. Demand is falling according to OPEC. Okay. It's falling, so it's bad. But falling from a positive number, meaning, I forget the numbers, but let's say they thought there would be a 2.2% increase in demand. Now it's only 2.1%. But you're like, that's still 2% growth, which would be normal. I would say in a good normal year, global growth at 2-point-something% is fantastic. So what they're saying is a drop from, let's say, 2.2, maybe only to 2.0. But you're like, but dude, it's still growing 2%. But nonetheless, price came down pretty hard. Will that be forever? Well, OPEC also talks about having quite a bit of supply because many OECD countries have tapped their SPRs. Okay. So anyways, there you go. Oh, thank you, Maida. That goes into the wine budget. Thank you very much. Oh, my pleasure. Absolutely my pleasure. Yeah, right, Ashish. Yeah. Okay. Now remember, everything is predicated on the now staying the same. And sometimes that's where, economists and traders step on each other's toes. At some point, like an economist will say, demand is down because of recession. Okay, great. But a trader has to come along and buy low at some point because they're saying, yeah, recession, sure, got it. But we're betting on the fact that the recession is going to be over and we're going to return to growth in the next 6 to 12 months. That's what a trader does. That's what an investor does. So you want to buy at the bottom, the trough. You want to buy in the trough. Actually, it's not quite true. If you look at like the real estate cycle. So I studied the real estate market quite heavily actually at Harvard. All right. But anyways. Okay. So you got to take your cycle. Okay. And because, it's basically a form of calculus, right? You got to break it into a quadrant. I'm trying to do this. Okay. And you want to track the cycle. So how do I draw this here? Okay. That's the real estate cycle. And you ever wonder why some people make money and some people lose money? Okay. Some people lose money because they buy here when vacancies are getting closer and closer to zero and rents are going up. Okay, think about that. If rents are going up and there's almost no apartments available, then the value of the apartment building is very high. What kind of economy is that? A growing economy or a contracting economy? A growing economy. People have jobs. They're moving to that neighborhood. They're paying high rents because they're fighting each other to get the last remaining apartment. There might be 5 people that want to rent that last apartment. So rents are high. Demand is high. The economy is good. Inflation is high. The cost of borrowing, so the mortgage on the apartment building is high, but the building itself costs a lot of money because of the high rents, because of the high demand, because of everything. And at some point, people keep buying an apartment building and they keep buying at the peak. They keep buying apartment buildings. And then it starts slowing down, but they don't know it yet. Rents are still high on the way down because rents are sticky. But people are leaving because they lost their job at the Amazon warehouse. But prices of the apartment building haven't fallen. The economy is not in recession yet. The Fed has not cut interest rates yet. So if you have to suddenly renew your mortgage on your apartment building, which is still very expensive, then the bank looks at what you're doing and they're like, but your vacancies are up. And you've had the vacancy now for 30 days and you still haven't filled it. Oh, thank you for the rupee. Thank you. That goes in my wine account. Okay, so this is where people lose money. The economy still appears to be good. But when they go to renew their mortgage, they're in a world of hurt. And then eventually the economy goes into recession and people can't afford to pay the rent. So you kick them out. Nobody's moving in. So you're slashing your rents to try to get people in. But everyone's losing their job. They're leaving the city. They're leaving your neighborhood. They can't afford the fancy pants place. So again, rents are down. Vacancies are up. Your cash flow's down. The Fed is slashing interest rates to try to save the economy. But it doesn't help you because it's too late, because the value of your property now has dropped by 20%. And so even though the cost of borrowing has dropped, you have to come up with money because you don't have enough to cover the mortgage. Because remember, you can only have 70% of the value, right? The bank doesn't want to have 20 or 30%, right? Or 80%, I should say. The bank doesn't want to own 80% of the risk. They want you. So all of a sudden they're like, you need to come up with more money. And you're like, more money? They're like, yeah, we need a couple of million here to give you the new mortgage at the lower rate. And you're screwed, right? Now somebody else comes along, smart money like you and me, and they're analyzing the economy ahead, and they want to find just after the trough. Rents are stabilizing, the economy is stabilizing, the Fed is done cutting interest rates, and the bank has taken over the mortgage of some apartment buildings. They were $2 million. The value was 2.4. The bank held it for 2. The guy paid it down for about 4 or 5 years. So really, there's only a $1.6 million mortgage left on what used to be $2.5 million apartment. But the bank is dumping it. The economy still hasn't recovered. Vacancies are still high. Rents are still low. The bank is sucking wind because now they're paying, right? So they sell you this $1.6 million mortgage for $1 million. So you buy here, and then the economy recovers after a year or two, breaks back through here, and your vacancies are falling. You start raising rates, your rents, your cash flow goes up. The value of your apartment building is going back to $2.5 million, on its way to $3.5 million, but you only paid $1 million for it. And then once you get into that mode, you sell at the top because you ain't no sucker, son. You sell up here. And everyone's like, oh my God, I need to be in apartment buildings. I saw a guy on YouTube. He was driving a Rolls Royce and has his own private jet, and he's investing into apartment buildings. I got to get into apartment buildings. Rents are high. Vacancies are low. Property values are high. Inflation's going up. Interest rates are going up, and you want to buy at the top. Huh? And you end up losing your shirt because you just bought the roller coaster ride of pain. What we call the poverty roller coaster. Okay? That's why you got to save money and be liquid. If we go into a recession next year, be ready to buy when other people are selling. That's all I'm trying to say. Okay? Okay, cool. S&P 500 is opening up today. Okay, go into a smaller time frame. It's looking great. Why don't we change the template though? Let's go let's do day trading. Guess we'll just do daily confluence, huh? Okay. And here's what's going on. Everything's right as rain. Okay. We've already hit today's target, so I'd be careful. To see, we've already hit today's target. Let me drop into a smaller time frame, like a 5 minute. Let me zooch in here. Oh, I'm zoomed in too much. Let's do a 15. There we go. Bullish profit zone aggressive. We're already done for today. So we're on tomorrow's trade. Notice we're through 4,000 and we just used it as a role reversal. Okay, buyers bought. Richard asks a question, would China easing COVID policy be inflationary? On the short run, yes. On the long run, no. Do you like those sort of off-topic conversations when we're talking about real estate when we're talking about portfolio construction around changing economic conditions? Or is that too esoteric? Lucas says yes. Yeah. Yes. Yeah. Sometimes I feel constrained under Forex. Forex is great. Forex is money. But to me, it impacts everything. That's why I like Forex. What transaction do you take? What kind of transaction do you undertake that doesn't involve money? Very few, right? So like 2 weeks ago, I did about 10 hours of charity work. So I gave my time and my expertise away for free. But why? How did the charity benefit? Oh, well, we raised thousands and thousands and thousands and thousands and thousands and thousands and thousands of dollars. There was still an economic transaction. I gave my money away, or my time away and expertise away for free, and they got thousands of dollars. Every transaction, right? Okay. Evan says, could have done the same thing, buying houses and renting them out. See, I would never want to do that, really. I'd much rather buy an apartment building. Okay. Much rather have, a commercial structure to the deal. I would even I made some phone calls. It must have been at the very beginning of COVID, because I remember I looked at a few hotels actually in Florida, Orlando, I believe it was. But I made some phone calls to, I can't say their names, but let's just say some billionaires I know. And I'm like, we need to buy everything up. We need to buy everything up. And they're like, so how do you want to structure it? Right? And I'm like, I think I should create a syndicate. And, that would be that would be the way you'd probably want to structure something. Well, buy a REIT fund, but you can also be your own REIT fund though, right? Basically, Peter, without all the restrictions. So I can create a syndicate, raise money from investors, provide like a hedge fund type service. So they put money in, and I could source the deals, structure the deals, raise the financing. Because even though you have investors, think of it. Let's say you have investors and they put in $10 million of their money. Do you go out and buy a $10 million property? No. Why would you do that? Especially remember when interest rates were basically free? No, you want all that free money. So you could raise 10 million from investors, but the bank can put 70% of the money in. So your biggest investor is the bank. So let's say you raise $10 million from investors, but you can get a $25 million mortgage. And you don't have to refinance the mortgage for 5 years. So very often what you do is you start the syndicate, you bring in the 10 million in cash, then you go out and first you got to have the deal. So let's say $25 million buys you 50 doors, right? An apartment building with 50 apartments in it. Great. So now it's 25, right? It's 25 million. You go raise 10, then you go, you're right. So now you got that 10, then you go into the bank and you're like, we can put this X amount, we can put the 10 million down. So they give you the rest. They put in 15 million. So now you got the 25 at the low interest rate. And then you buy the property, you earn a management fee. You usually get a sourcing bonus of 1%. And then when you sell it, you get 1%. And the expectation for the bank and for the investors is that within that 5-year period, you dump it. So again, at the bottom of that cycle where you buy at the trough when everything's cheap, and then it goes up 5 years later, the rents have gone up, the vacancies are gone, it's 100% rented out, you're collecting money hand over fist, right? And the property has gone from 25 million to 40 million. And is expected to go from 40 to 50, and that's why some other guy wants to buy it. So then within the 5 years, you dump it. The bank gets paid back their loan. But remember, you only owed them 15 million, plus over 5 years, there's been amortization. So you probably only owe them 12 million, but you just sold it for 40. And the rest gets divvied up. Most of that profit goes to the people that put in 10, but you were the fund manager. You collected a percentage over the 5 years. You got probably a percentage in. You probably got a percentage out. And then you get a percentage of the profits, a small percentage, but you get it. And all of a sudden you're like, you just cleared probably, 5 million out of the 40 goes into your pocket. And it was all a syndicate deal. Now you did all the work. But everybody else ponied up the money. The bank ponied up the money. The investors ponied up the money. You did all the work and you only made $5 million. Well, that's pretty good. That's $1 million a year. Okay. So that's what I was looking at back then. I'm like, I don't want to own the apartment building, but I could create a syndicate and put that together. Right. And that's how you structure that kind of deal. Right. Man, my phone is going off like crazy. I'm like a pimp. My phone is ringing like a pimp. PIMP. All right. Anyways, look at this. You didn't tell me we were going to talk about real estate syndication and structuring, right? Structured finance products. You didn't tell me. I could have prepared. Yeah, well, that's the thing, Monday. I don't want like I said, I'd rather have one apartment building with 50 doors on it with one roof and one lawn, one insurance company, one power bill. I don't want 50 insurance companies, 50 roofs, 50 lawns, right? Like, I don't want to own a bunch of houses. That sounds terrible to me. When you buy a commercial investment like a large apartment building, one of your expenses is a management fee. Usually what, 10% of NOI? Boom, done. Now I don't have a problem. But I have one expense for insurance, one expense there's only one roof to repair. There's only one lawn to mow. And I don't even have to do any of that. That's what my management company has to worry about. But the thing is, I have rent coming in from 50 people. And if one of them move away, it's not going to crush me cash flow wise. I still have 49 rents that I'm collecting, and we'll quickly fill that rent back up. But meanwhile, we'll paint the apartment and put in new carpet and keep our rents high because it'll be a nice place to live. It won't hurt me much. But doing houses, you're constantly going through, right? So I would never want to own 5 or 10 houses. Okay. Anywho. All right, let's take a look around the world. Let's start with exotics. So those two trades are doing okay. Nothing really to add. Everything's right as rain. Everything's worked out. Nothing really to add. The stock market going up today would benefit this. That should weaken the US dollar. Is that right, Richard? I'm just saying it's a lot of work. A lot of people go into it like, oh, it's a way to make a quick buck. No, it's not. Monday says saved him a lot of money last week. Cool. Stopped you from shorting. Right on. Richard says costs are getting high. Yeah, I would imagine there's better investment opportunities right now than that. The money's come and gone. See, that's the thing. Like back when COVID hit, that's when you were supposed to be buying. Not necessarily as it was hitting, but that's when you start looking around. So an apartment building is just cash flow. That's what I was trying to get through. You're just buying a cash flow. It's like buying a bond. It's just a cash flow. It's an instrument. An apartment building is an instrument. You're buying future cash flows, and it comes down to your profitability. That could be your interest rate, or it could be your borrowing cost could be your interest rate, or it could be your level of inflation, which could be your interest rate. But the thing is, there's a value. I can tell you what an apartment building is worth down to a fraction of a penny. So that's all you're buying is a future cash flow. Right? So now that interest rates are high, you should know. You should have sourced all those deals when prices were down. So I looked at, like I said, quite a few apartment buildings, but also quite a few hotels. They're just cash flow. Remember how hotels were getting crushed during COVID? All you had to do was say, well, I don't think COVID's going to last forever, but I understand for a year or two or three, some of the hotel chains are going to get crushed. And there were quite a few hotels. Now, it's interesting. You look at a hotel and it says like Hilton on it. Hilton doesn't own that apartment building. It says Marriott on it. Marriott doesn't own the building. You could buy a Marriott. I looked at them. There were all kinds of hotels available. Some of them were brand new. So I'm like, I called up my friends. You're like, dude, I need 100 million. What do you think? We'll go out. I'll buy, we'll get, there a couple of them were brand new hotels within driving distance of Disney. Brand new, like 2-year-old hotels. New marble in the foyers. Like everything was crisp and clean. And soon as they opened up the hotels, COVID. So guess what the price would be if the hotel has no revenue this year, not expected to have any revenue this year because COVID, and have really no guidance for the year after as long as there's COVID. Disney was closed. People were not traveling on airplanes. Like these guys were in trouble. Well, you pick them up for pennies. Pennies, dude. Pennies. Now what? Dude, I went to, not Disney, the other one. One that serves alcohol everywhere. It's awesome. What is it? Universal. I went to Universal earlier this year. Oh my God, it was packed. Those hotels were packed. Should have bought them. Okay. It's only money. But you have to understand structured finance. All right. We can move over to like dollar pairs. Okay. I'm going to move my stop to break even here. So we've already hit the top. We've already hit 120. I wanted to show you this. How much do I have left on it? So I've given back quite a bit. I was up about 650 pips earlier this morning, but of course, this is a coaching account, so I'm just kind of showing you how to build. So anyways, that was doing all right. We'll see if it continues. Richard says it's hard to find apartments. Yeah, well, that's the thing. They're not for sale because you can't buy another one. Right? So, Richard, no one's going to... Meanwhile, occupancy is probably zero. Rents are going up at least at the pace of inflation. So nobody's going to sell, Richard, until what? When is there going to be capitulation? That their mortgage needs to roll over and be refinanced. So every landlord will have a different timing for that. And it comes down to how they invested and reinvested. Can they afford the mortgage if their commercial mortgage goes from 4% to 8%? Can they afford the monthly payment? Because they may have stripped all the money out of the apartment building, right? And not anticipating the mortgage doubling. So imagine this, like you got this apartment building and let's say every month your mortgage payment is $100,000. Cool, but you're collecting $140,000 a month in rent. So you got $40,000, and you're buying cocaine and cars and prostitutes and everything with your $40,000. And then all of a sudden interest rates go up. And you're like, I'm still making 40, and your rents go up. Now you're making now you're making $50,000 a month. You're a genius, right? Rents have gone up, and it's just more cash for you. So you're spending and blowing all the money. And then all of a sudden it's time to refi, and they're like, okay, your new mortgage is $200,000 a month. And you're like, wait, what? But I'm only collecting $150,000. Now you're losing $50,000 a month. That guy didn't play his cards well. And now we'll lose the apartment building. Because they're like, yeah, well, to lower it down to only $150,000 a month, you will need to put in another $1.3 million. That will lower your mortgage right? Because we're putting in less money, so your mortgage will drop. And after you put in 1.3 million, you will be break even. That's when the dude sells. Because the dude wasted the money. And I know that's an extreme example, but you know some people do that. And that's the guy who's going to sell the apartment to you for cheap. Because he's an idiot. Go. So, anywho, that's a real world example. It truly is. That's who loses. Yeah, I would agree. The thing is, though, Matrix, sometimes you have to. Okay, sometimes you have to. Because, for example, interest rates have gone so high you can't refinance. And you're forced to sell it. Also, the United States has a mechanism. It's a way to exchange a commercial asset like an apartment building for somebody else's. You don't sell it. You trade it with somebody else. They get your apartment building. Okay, you get their apartment building. And you exchange it. Now, this is interesting because it's a way to keep getting bigger without ever selling. And you don't get taxed like you're selling. And then there's another thing where in the United States, you can depreciate your apartment building. And it works so amazingly well in the United States that once again, you never sell. You only trade, because if you sell, you have to pay taxes. But I want you to think of it this way. If you sold your apartment building, but you depreciated it at the same time, you run into a trap. A depreciation is when you tell the government that you bought this apartment building, but over the last 10 years, the apartment building got older and older and older and older, and it's worth less than it used to be, right? So because it's losing value because it's getting older and older and older, you're able to not pay taxes on it, which means you essentially get to pocket the money you depreciated. So you could claim every year your apartment building is worth $500,000 less than the year before, and you put that $500,000 in your pocket. So now you don't really care about anything else, do you? As long as rent covers the mortgage, you don't really care. You're getting paid through the depreciation. This is where, when Democrats reported Donald Trump was broke, that he was lying on his taxes and he actually doesn't have any money. That's true. That's how rich people in America get rich. Rich people don't have money. So Trump owns billions and billions and billions and billions of dollars of real estate that essentially doesn't make any money. Money is for poor people. So it collects rent, or if they're hotels, it collects whatever, right? Cash. And then it pays down expenses, and it pays its employees, and pays its insurance, and all that kind of stuff. And maybe at the end of the year, it breaks even. Maybe it makes a little bit of money. Maybe it even loses a little bit of money. And so that all gets declared on the tax returns. Keep in mind, on the billions and billions and billions and billions, let's say on $10 billion worth of assets, all of which are depreciating, all of which are declaring they basically break even after expenses, they depreciate, let's say, $1 billion of it, and that goes in their pocket. So the tax returns show the entire portfolio sucks. It doesn't make any money. But you live on the depreciation. Hello? Because the real estate doesn't lose value like that. It goes up in value over time, not down. So if you actually do have to sell it, it went up by 50%, but that's when you get into a trap. So if you sell an apartment building, you depreciated it for 10 years, and then you sold it for 50% more, the government comes back and says, whoa, 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 whoa. You told us it was losing value. You depreciated it. But instead of losing value, it went up in value. So you owe us all that money back. So that's why you never sell it. You never sell it. So you trade it with somebody else for something bigger and you grow. Because if you sell it, you owe all that money back. So that's why in America you don't sell it. But do you know how the game ends? What happens when Trump dies? They sell all the properties and pay taxes, right? No, not in America. So let's say you just keep buying real estate your whole life and you're living on all the depreciation, And none of your properties make money. They all break even, but you pocket the depreciation. All that tax-free money is going into your pocket. Boom, boom, boom. That's why you never pay taxes. It's tax-free. It's just money going into your pocket. Okay? And then in America, you never sell the building. You just trade it for someone else and you get more property. And then you do that for a while. It goes up in value. So you trade it with somebody else and you get more property. Then over time, it goes up in value. You trade it with somebody else and you got more property. And at the end of it, you've collected billions of dollars tax-free and none of your property has turned profit. Then what? You die, you leave it to your kids, and that depreciation tax bill, which could be $5 billion, goes away. Your kids don't pay it. Your kids, okay, because it's basically when you give your property to someone else, so you die and it gets transferred to your children, it's considered a sale. But because you never sold, the person that died never sold, never got a tax bill, collected all the depreciation their whole life, and the depreciation gets washed out and the children just get the billions in real estate and start the whole thing over again. And that $5 billion tax bill goes to zero. Oh, America! Oh, America, I love this country, huh? You don't do that in other countries. America. And that's the funny thing. So people say like, the secret to wealth in America is real estate. So they go out and buy 5 houses. You can't do that with houses. That's not how you do it. You need commercial properties, warehouses, hotels, apartment buildings with 50 doors on them. Okay? And you never sell. But you got to get bigger and bigger and bigger and bigger and bigger. Bigger and bigger and bigger and bigger. And I'll tell you what, you'll never make money. You'll fly around in private jets. You'll have a Rolls Royce and a different Ferrari for every day of the week. You'll live in a house bigger than a bus station. And everyone will point fingers at you and say you're poor because you don't have any money. And they look at all your assets and you're like, none of these apartment buildings make any money. They all break even. Yeah, that's right. Go ahead. While Trump flies around in his private jet worth $100 million, you can laugh at him and tell him he's poor. He's practically bankrupt. Yeah, well, talk to the pilot flying the $100 million jet. Huh? By the way, it costs $40,000 just in jet fuel. Doesn't sound poor to me. He just doesn't make money. Money is for how poor people get compensated. Hey, thank you for mowing my lawn. How much do I owe you? $100? Thank you for mowing my lawn. There you go. Okay, right? Okay, that's not wealth. Wealth is different. Can you do it in Canada too? No. Okay? No. But that's how money works, guys. It's only money. It's only money. Okay? So, we go back. Why would you study economics? Does economics put you into any of these trades? Well, yes and no. So, when I'm talking real estate, we're talking about finance, right? Finance won't put you into a trade. When I'm talking about analyzing whether we're going into a recession or not, that's finance. Finance doesn't put you into a trade, but what we're trying to use is economic and finance studies to try to discern where we recently have been, where we are right now, and 3 likelihoods of the near future of where we will be. And where we will be in the near future is investing and trading. Your ability to accurately predict the future. and turn that into a trade. Man, my phone is on fire. I got so many meetings and stuff today. Anyways, so we're trying to predict the future 3, 6, 9, and 12 months out and look at how the market makes choices. Will a real estate investor buy a new apartment building? Will someone who's been saving to buy a house instead choose to rent an apartment? Will somebody buy a new fur coat at Saks Fifth Avenue? Or are they going to go to, what do they call it? Off Fifth, which is their outlet store, right? Are you going to the, right? Are you shopping at outlet stores? Are you shifting down to Walmart? Are you shifting down to the Dollar Tree? Are you eating filet mignon? Or are you eating a can of tuna fish with some scrambled eggs because you can't afford beef? It's stupid. Hamburger is $10 a pound. Okay? So you're like, I can't afford that. So you shift your behavior. Our ability to understand the science of scarcity and how that impacts consumers and investors like us will tell you whether you should be a year ago investing into prisons and dollar stores and apartment buildings. Okay? And right now we're trying to decide 2023, what's it going to be like? What's the first quarter going to be like? What's January, February, and March going to be like? This is our job. And if you can start putting that together, you understand why the market is doing what it's doing. Okay? Okay? Matrix says, how about we just make our own clothes and stuff? Oh, you totally can. But the issue is that's inflationary. You should be wealthy enough to pay someone to make clothes for you because it's a waste of your time. And so it would be somebody else would do it because you're saying something about your natural resources on your own land. All right. If you're digging in the dirt on your land, growing stuff or pulling stuff out of the ground on your land, and you're making $1,000 a day, why would you stop to make clothes when you can just pay somebody $50 a day to make make clothes for you? So you're like, I can't stop being productive. I'm just going to pay somebody else because it lowers your cost. It would cost you $1,000 a day to make your own clothes instead of $50 a day. So you're like, all right, you make clothes for me. Here's $50. And that's right. Now, when we are talking about economies making that decision, hey, China, make clothes for me. Hey, Vietnam, make clothes for me. Hey, El Salvador, make clothes for me. And China says, well, we can make clothes for you, but we would rather make laptop computers for you. And you're like, you're right. Right? They might have an absolute advantage on clothes, but the cost might be higher. So you're like, well, I'll go with the laptops because relatively, China can make them way better than anybody else. And then, but of course, China, if they wanted to, can make way more t-shirts than anybody else. So then I go to El Salvador. I'm like, what are you going to make for me? Can you guys make laptops? And they're like, no, but we can make t-shirts. Well, what's your cost? And I look at their prices, way cheaper than China. All right, El Salvador, make some t-shirts for me. Then I go to Vietnam. I'm like, what do you guys make? And they're like, well, we can make bicycles and we can make running shoes. Oh, okay. So I go with running shoes. So China's making laptops. Vietnam's making running shoes. El Salvador's making t-shirts. Meanwhile, I'm digging in the dirt, pulling stuff out of the ground. Look at me, I got cobalt. At $1,000 a day productivity, El Salvador is making t-shirts for $1. Okay? Vietnam's making running shoes for $30, and China is making laptops for $100. And I'm happy as hell because now I have t-shirts, running shoes, laptops, and I'm selling my cobalt for more than I can imagine. And I'm being super productive, and my expenses are falling because I get all that cool stuff for cheap relative to what I'm doing. So my standard of living is going up, my inflation level is going down. Meanwhile, those countries are getting business, so cash is flowing toward them out of my pocket and into their pocket. That's what we do, by the way. When money is leaving American wallets and going to Chinese wallets, that means two things. Americans are spending money and getting high quality value for a low price. Our inflation is falling, and the value of our dollar is falling. Because I'm sending my dollars to somebody in China, and they're like, awesome. Right? So I'm telling you, you don't want to get in a situation where you're making your own clothes. It's inflationary because it destroys productivity. If you're doing something on your land and you give up that opportunity, instead you go home and you sit and make clothes for a day, then the entire economy is losing your productivity on what you were doing at high value. So if you were producing wheat, people are going to starve because you want to make dresses. Oh, but they make me happy. I just love sewing. Dude, nobody wants your happiness. Get out there, grow some frickin' wheat so we can eat. Now, of course, I'm exaggerating, but that society wants that productivity. You might want to start study, I think it was John Locke who was talking about corn. I think it was corn. And he's like, this is my private property. If I grow corn, you shouldn't be able to come in and just take my corn. Okay? And if I have excess corn, I could trade it if I want, or I could just let it rot in the field. It's my corn, screw you. And the only reason I would pay taxes is if you come on my land to steal my corn, the police or the army is going to show up and protect my private property. And that's the only reason I would pay taxes. That's what John Locke would say. And then the counter argument to that, and I think it was the guy that wrote Leviathan. I forget what it, but anyways, this counter argument was, yes, that's true. That's your private property, but you do have a moral imperative to trade. And I follow that prescription, I guess. I subscribe to that point of view where you have a moral imperative to society to maximize your productivity. Because the more that every single living person, in this case, in the United States of America, contributes to GDP, the better every single living soul within these borders benefit. And not just money, because you can tell me, Wayne, you're just a capitalist pig dog focused on money. I can show you that people will die an old age with a smile on their face if they have a life that is productive and rewarding, because it creates self-worth. You were worth something. People needed and relied on you. You woke up in the morning, you had a responsibility, you took care of it, and it was high fives all around. Good job, man. Awesome. And I'm over here doing my thing, and everyone's going to be rewarded. Huh? You will live longer. You will die fulfilled. Like I said, with a smile on your face because you were needed. Society relied on you and you were reliable. Okay? I don't think people on welfare die happy and fulfilled. Oh, that was a good use of my life. I don't think so. Something about waking up in the morning and being needed. and then providing. Self-worth and dignity. So I'll leave you with that. Peace on earth. May the business be with you. May your profits be above average. Pachow. Hey, that just happened.